Hello everyone. As we do at the beginning of each quarter, let's take a look at the main conclusions that can be extracted from our digital top-down methodology. Our methodology consists of evaluating the attractiveness of European equities based on 4 complementary pillars of analysis. The first pillar focuses on the economic momentum in Europe. Our proprietary indicator remains at a historically high level, despite a slight easing from the peaks seen 6 months ago. Economic growth over the next 12 months is unlikely to weaken. Consensus economists anticipate GDP growth of plus 1.0% in 2025 in the Eurozone versus plus 0.8% in 2024. However, we cannot rule out the possibility that this cyclical signal, which has been supportive of equities for 21 months now, will reverse during 2025. The second pillar relates to the ECB's monetary policy. Last June, the ECB initiated its accommodating monetary pivot, cutting its key rates by 100 basis points in 6 months. This sustained pace is set to continue into the first half of the year, and will continue to favor the equity asset class, particularly small and mid-cap stocks in Europe. The third pillar of our analysis covers valuations. The European equity market risk premium is close to the average observed since 2000, while the small and mid-cap segment is discounted by around 15% relative to historical norms. In this context, it would not be surprising to see a significant outperformance of the small and mid-cap segment in the first half of the year, which would normalize the valuations of the various market segments in both absolute and relative terms. Finally, the fourth pillar deals with the behavioral aspect. As we had envisaged since our video at the beginning of April, the indices have moved more horizontally, without at this stage affecting the long-term uptrend. Small and mid-cap indexes, for their part, have accumulated a significant lag, and chartist configurations suggest a return of the latter towards the 2021 highs, more than 15% above current levels, while seasonality remains supportive until May. After European stock markets have risen by almost 40% in just over 2 years, it may seem legitimate to question the sustainability of the current rally. However, we believe that it is still too early to reduce its strategic exposure to equities. Our economic momentum indicator continues to signal a favorable environment for the asset class. Monetary accommodation by the ECB, far more powerful than that anticipated for the Fed, is unlikely to falter, at least in the first half of the year. Valuations do not show any excesses, or even a significant undervaluation of the small and mid-cap segment, and seasonality remains favorable until May. That's all for today, and we look forward to seeing you at the start of the next quarter for another market review with Shaheen Capital.